Hello, everyone. Happy holidays. Merry Christmas. We hope that everyone had a great holiday season. I'm Frank Griffin. This is Mark Davis, and we are co-creators of True North, podcast focusing on helping you find your path forward. Our focus is always going to be around faith, family, and finances. And in season two, because it's so important, we decided to spend the entire season talking about finances. Right, we are focusing on trying to provide you a toolkit, if you will, or a toolbox that you can leverage based on whatever age or stage of life that you're in for any financial situation that you might be in. So we're excited about today's podcast. We're going to talk about asset management and some of the basics of wealth building. And don't let me forget, I'm trying not to forget, if you like our material, please like and subscribe to our podcast. But I'm excited about today's podcast. Mark and I spent a little time reviewing that and just the importance of asset management. And we'll kind of scratch the surface on some basics of wealth building. So, Mark, I'm going to turn it over to you. All right. We can just kind of go from there.
Thanks, Frank. As Frank mentioned, we're excited to bring these podcasts to you. We are not experts. We are two guys who experienced a fair amount of life and a fair amount of success and some failures along the way. We want to pass those along to you. We don't believe that you get these kinds of what we call more raw, direct discussions just as you navigate life. There's some insider things that we see as corporate executives, etc., ministers. Frank is a doctor of ministry. We just want you to know that he's humble. He won't say it, but I will. And we pulled all that together and feel like we're setting you up with a foundation that you can build upon. As Frank mentioned, you can build your family, build up as a person who leads a family or member of a family, obviously. Your faith, where are you going to go when things go wrong? Your friend, what wisdom do they have that you don't have?
Good.
There's a lot of folks around you whose their foundation is a little sketchy. So part of True North is anchoring you to what you believe in and then tying your trajectory of your life together so that you're moving on a path forward that you're going to be happy with.
Excellent.
So, as Frank mentioned, today we're going to talk about asset management and wealth building. As a reminder, if you've watched any of this season of our podcast, or this series of our podcast, you'll know there's a couple of key principles that we believe in. One is that to be successful with finances and to advance your financial literacy, two things you have to know and have to possess. Discipline and be able to do a little bit of math. Don't run from the math.
Right.
If you don't have those two, it's very difficult to advance in the financial space. And again, as Frank opened up with, we're passing this along to you because I don't know how many people will tell you those two go hand in hand. So with that said, financial stability is very important as you move on your true north. Frank and I were just talking about it. If you're not starting to accumulate some financial stability in your 30s, it's going to get harder in your 40s. And you really don't want to have financial instability in your 50s.
No.
So whatever your trajectory is in life to your true north, financial instability is a problem if you don't get that under control. Frank, I don't know if you wanted to add anything to that.
No, I agree with you, Mark. It's essential. As you get older, right, it's just normal to have instability in your health, right? When I wake up every morning and I hear my knees popping and my back hurt and I've got an injury that I don't even know where it came from, just because I'm in my 50s, that's just normal. That's just what the body does. That's instability in your health. But you can control the instability in your wealth much more. And you want to do that. Absolutely. Absolutely, Mark. And to your point, Mark, and I appreciate some of the accolades, but Both of us came from the west side of Indianapolis, right? So definitely came from some of the poor sides of Indianapolis. We both came from that humble beginnings.
Low wealth. I like to describe it as low wealth.
Low wealth. That's right. We were in that low wealth category, but we both have pressed and received some level of success. Mark is the chief operating officer of his company, a $1 billion company. So we both have done fairly well. We just want to share with you some of the things that we have learned. Just real quick, from a biblical perspective, as it relates to your true north, money is spoken about over 2,300 times in the Bible. So clearly, money is very important to God, and so it should be very important to us, right? There is a one of the proverbs, I think it's in Ecclesiastes. Yeah, King Solomon said this. He said, "A feast is made for laughter, and wine maketh merry, but money answereth all things." What Solomon was saying basically is, we can have a good time and we can party, but eventually we need to make some money. And you need to do that. That generating wealth is what you need to do to solve some of the problems in your life. If you're not making money, right, then you're going to have problems you're going to run into, and it's going to be very difficult for you to handle those. That's that instability part. So money is definitely something that is very important as you try to navigate to your true north. So asset management, I'm so excited about that, Mark, right? We talked a little bit about it. It's just some things that we need to start thinking about that I have not heard other people talk about, right?
Sure.
In some of these other podcasts. So just kind of hit some of the things that's on your heart, in your mind, or as it relates to the basics of wealth building, asset management.
Sure. So the fact that we are a self-help / educational podcast.
Good.
I got a question for our audience.
Mm.
Other than your house and your 401k, what do you own that goes up in value, appreciating asset? And I'd imagine for a fair number of us, the answer is nothing.
That's right.
Your car doesn't. None of the other toys you buy, unless you maybe buy art,
That's
might
right.
go up in value. But coin collections, smaller things like that.
Mm-hmm.
If on your path to your true north, you maybe have desires in the entrepreneurial space, which I don't. In the real estate world, no background there. I'd encourage you, if your passion is down one of those two tracks, seek out information and knowledge from someone who's done those things, and be disciplined and studious and learn from them. My passion, Frank and I talk about this, is in the stock market, owning equity in companies. So if you look at your phone, nobody gives us any money for advertisements, so I'm not naming names. Being a stockholder in that company means you own a piece of that company.
That's right.
Very small, but you do. So that flamboyant CEO you see on the news works for you. That's the way I look at, well, it's not even the way I look at it, it's the realities of owning stock in a company. You'll find that if you accumulate enough stock in an individual company, you'll get a proxy for the shareholders to vote on board members. The first time that came to the house, I thought, you got to be kidding me. From west side of Indianapolis, now I'm getting proxy statements for a company worth almost $1 trillion.
Right.
Like that. I like that. So that's one of the positive, or a couple of positives I see on the stock front. Some folks call it gambling, et cetera, et cetera. And educate yourself.
That's right.
It is a tool and a vehicle that has led to so much wealth for the majority of the people in the country.
That's
real
true.
estate and the equity side stock market. So that's something that you should focus on. Also, for those who are maybe, especially in their 40s or 30s for this matter, you should have an eye out toward retirement. You don't plan on working forever. And Frank and I talk about this. I want to live the same lifestyle in retirement that I live now.
Right.
And the way that I do that is over the course of the 37 years I've worked, I've been training myself, but I've also been training my employee. My number two employee is my wealth.
Mm-hmm.
So my money works for me, not
That's
the
good.
other way around. At some point it transitions where I get to sit on the Pacific coast and chill while it's putting in work and I'm relaxing. And also we talk a lot about passive income.
Mm-hmm.
Well, stocks can do the same thing. Their growth, appreciation, you're earning wealth or you're growing your wealth while you're not really doing anything in addition. And there's a component of some stock, not all of them, they pay dividends.
Mm-hmm.
So they'll take a piece of their earnings and send to you on a quarterly basis. If you want those in your pocket, they will send them to you.
Mark,
If
you
you
might
want
have.
them to go ahead, Frank. If you want them to add up on your investment, they'll just keep adding it to the pot of what you already own.
I apologize for interrupting, man, but you made just a huge point that I want our audience to really think about. As you're younger, you're working for money. You're trying to build wealth, right? But if you do a good job with that, eventually your money will start working for you and making as much as you are in your efforts. And that's what you want to get to, that point where your money is just what, if you're working, if you're on vacation, whatever, on the weekends, whatever you're doing, your money's still working for you. It's your employer, right? And you want to set it up so it can do that. So I think that's an excellent point that we need to really start thinking about, just not working for money and spending money, right? And living paycheck to paycheck, but building wealth, asset management, so that money will work for you. I think that's a key point.
And I throw in there, Frank, the dividend component. Some folks prefer income, need to bolster their income as they move into retirement. Well, owning dividend producing stocks, those are a good place to go. I mean, it happens. You quarterly, you either have the deposit in your account or a check shows up in the mail.
That's right.
That's kind of a neat thing because that, in fact, is your employee working for you.
That's right.
And you'll also find that, companies that have high dividends typically don't grow as fast as, say, a high-tech company. They don't. Correct. So their angle is pay out as much as they can to their stockholders. So the pressure, if you work at those companies, earnings per share. How much are we earning for every share that Frank owns? And that's where the pressure for those companies comes from, as opposed to, new cameras on the phones and that kind of thing.
That's right. And that's an excellent point. That's low risk money for those companies that are paying dividends, right? That's low risk money, consistent return on your investment, right? If you look at the stock market, I've heard you say this, Mark, but gambling, Las Vegas, absolutely. If you look at a trend, if you continue to gamble, the trend is going to be, you're going to lose money. Vegas is always going to win over time. If you look at that same trend over time, 30, 40, 50 years with the stock market, it always trends upwards. It always has trend up. So that's not a gamble, right? Data is telling us that that's a very good investment, very good investment. So there's nobody looking for self-help. If you have a gambling problem, they say, seek out this help. No one said if you have an investment problem, seek out this help. You just continue to invest. I'm sorry, what were you saying?
Well, Frank, a lot of folks see the stock market dip. And in the times we're recording this podcast, the market is down quite a bit. You only lose if you sell when it's down.
That's right.
You ride it out. We had the Great Recession in 2008, 2009. Ride it out. And if you can, if you have the experience, that's a good buying opportunity.
Absolutely.
For those
Absolutely.
of us who shop retail, you really like sales. Well, I heard an expert say, ditto. I heard an expert say, stocks are on sale right now.
Stocks are on sale right now. That's awesome. That's
Yeah,
excellent. Yeah.
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 So if it's a soda company or it's a company that makes razors,
Hmm.
I doubt they're going out of business anytime soon.
No.
So
No.
when you get in, trying to time the market doesn't work.
That's right.
But over time, you're going to see close to a 10% return. That's what the stock market has returned. I believe that's the S&P 500,
Hmm.
largest 500 companies, has
Hmm.
returned an average of like 9.85%.
Hmm.
That is that's a great return.
That is, and
You're,
that means that you can double your money every 7 years. It's the rule of 70. Rule of
yeah,
70.
72. Rule of 72.
72. 72.
Yep.
Yeah. Yeah. That's a
So
tremendous return.
absolutely. So one of the things that I want to offer to our audience as well is uh, challenge yourself to show the discipline to acquire an appreciating asset
Mm,
in the next whatever time frame fits you.
mm.
I'm a quarterly guy, so we're the end of the year for this recording. By the end of the first quarter, I will have decided what other investments I'm going to move into.
That's good.
I'm not going to try to time the market. I'm going to look for quality, and investing versus trading is two different things.
It is.
Yeah,
It
you
is.
try to trade stock. Oh, it's high, sell. Oh, it's low, try to buy it. That computers do that.
That's right.
You will not win. I know people that back in the .com era, they
Hmm.
quit their job
Hmm.
to be a trader. Guess
Hmm.
what? They
They
went back to
lost
work.
because they had to. Because they had
Because
to.
they had to. You're
Yeah.
exactly right. So
Yeah.
I challenge this, whoever's listening to us, whatever that period of time is, a month, 3 months, 6 months, a year, try to find a way to buy something that goes up in value.
That's really good.
Because you're spending hundreds of dollars a month on a vehicle, which you have to get around. I get that, it's a necessity.
Hmm.
But a percentage of that could you move toward an asset that appreciates? Mutual funds, what have you.
You made a key point, and that for some of us, a process or goal helps. I'm a process goal kind of guy. Look at your budget. We've talked about budgets before. See what percentage of the money that you have that you can put aside for this asset management. In fact, I don't know, 10%, or that's a dollar figure, $100, $500, $50, whatever, and start putting that money towards something that will appreciate in value over time, building your wealth. And
Yep,
do that on a consistent basis, you look back and you've built quite a bit of wealth.
yep. And
Yeah.
you'll get to the point where that wealth becomes a bit of a snowball.
Mhm.
The
That's
more it
good.
rolls downhill, wealth begets wealth.
That's
So
good. That's
that's
right.
that's how that works.
Hmm.
And you made a great point, Frank. I want to unpack a little bit. Most employers
Hmm.
allow you to electronically direct your paycheck to
Hmm.
more than one place.
Hmm.
So yeah, your checking account, but if you had, say, a brokerage account or even a
Hmm.
savings account,
Very good.
do that automatic.
Hmm.
You'll never see the money. That way, your savings or your asset accumulation is not in conflict with your Starbucks, your hair,
Good.
whatever it is, your Jordans, your movies, your game, whatever. You still enjoy those things because you never saw the money come in the house anyway.
Excellent. That's good. That's
So
good.
your automatic investing on your 401k, and we talked about that. You
Hmm.
got to get up to the max level.
Hmm.
That's savings 101. If your company's matching you dollar for dollar up to 3%, 5%, whatever it is, that's saving 101.
Hmm.
Just chip away. If you can't do it all at once, chip away at it. When I had 3 kids, I got to the matching level, but I couldn't save a whole lot of money beyond that. So trying to give you a dose of reality, but really push. I always got to the matching level, regardless. And now that same money is paying tremendous dividends. And one quick example, Frank.
Good.
My old employer had some trouble. The stock went from $25 a share to 97 cents a share.
Okay.
Now, if you think about it, I just kept buying. So to this very day, I have stocks that I've accumulated for 97 cents a share. And that's 22 years ago.
That's good.
So, but now it's my employee. That's working well for me.
That's right.
So, go ahead.
This is really good. You find a solid stock or solid company, and you mentioned this, Mark, it will not go out of business, right? Certain companies we know are going to be here another decade, another half century, another 100 years. It's just going to be here. Things we need: fast food, electronics, pharmaceuticals, razors, like you said, it's going to be here. So you find a company that, and regardless of what the stock market does, it typically does it in groups. The Dow Jones, certain measures, it's not just that one stock's going down, the whole market is down. You just hold on, or if the stock is on sale, you buy more because you're going to make money. You're going to make money. So it just makes a lot of sense. Something else you said before, you talked about, and I think you're going to maybe get into, is the cost of money. Even when some of our listeners, right now, interest rates are going up, that even the bank in your checking or savings account might give you 4 to 5%. So you might just even start there, redirecting some of your cash to this savings that you will not touch. Probably a savings account, not a checking account, a money market, but something that's going to give you low risk and then a decent return. 4 or 5% is not a bad return, right? And then as you build that, if you want to try something else like stocks, you find a stock you're interested in, you start moving that money, right? I love the idea of having your money redirected directly into these vehicles. You never see it. You learn to live on the other part of the money and then just allow your money to work for you. That's a great way to handle it, Mark.
Yep. I like how you shared that, because if you're getting those kinds of returns on a savings account, for this whole audience, like we talked about, getting something done between now and whatever your time frame is.
Yep.
That's a bit of a layup, assuming you have positive cash flow.
That's true.
Check one of our prior podcasts. We talk about that. You got to have more coming in than you have going out. Otherwise, the whole thing, everything we've talked about falls
apart. That's right.
But so for the challenge, Frank just described the easiest way in my mind to make these things happen. Check with your employer. Like I said, this is start of the year. See if you can redirect a portion of your funds to a savings account. If you got a brokerage account, shoot to the money market. That's what I did.
Me too.
And by shooting it to the money market is direct access to the stock market. But it's safe. It's not investment. It's not in the stock market. It's just ready for you to put in the stock market and put to work for you. So you don't have to worry about those fluctuations, ups and downs, and what have you. But you're going to earn some money on your money, even though it's not at the highest level of returns like the stock market. So I want to make sure. The cost of money, we did talk about that in the prior podcast. That's something you really want to be aware of. As Frank's mentioning, if the bank is paying 4% on a savings account, if they're loaning you money, I guarantee you they're loaning you money a lot higher than 4%.
That's right.
That's how the game works. That's how they make money.
That's right. Very good.
So it's something you have to be mindful of in any transaction you make. What are they going to charge you versus what your money can earn? So I'll flip this around a little bit.
Good.
If the bank is going to pay you 4.5% on a savings account, but there's a passion in the bank, and I've had this happen. they want to increase their auto loans. So they
Mm-hmm.
might discount those loans down to 2%.
Mm-hmm.
So now I'd pay them to earn my 4.5 to 5.
Mm-hmm.
Basic math.
That's good.
So those are the kind of things, and I don't want to kind of revisit a lot of what we shared in a prior podcast, but that's the kind of thing you want to look at.
And I'm sorry, Mark. I just think that, and I know we have talked about this before. I just think that it's so important, and I don't want people to miss that that simple brilliance that you just shared, right? That if the bank is going to give you a loan for 2%, instead of you taking cash out of the bank that's earning 4.5%, use their money. Basically, that's what you're saying, right? Use their money, right? And continue to allow your money to make more money, right? So sometimes we feel, and we said this before, that it gives us a sense of pride to pay things with cash. That's cool. And I thought the same thing. But as you build wealth, you don't want to use your employer, right? Or unnecessary. It's like taking a Harvard graduate MBA and I have them to type letters for someone as an administrative assistant. Makes no sense,
No sense.
right? Yeah, it makes no sense. So why do that? So allow your money to continue to make money, and then use the bank's money, right, to do some of those other things. So I just think it's something that we have done for generations, right? And we thought it was the right thing to do, but it's not. Right. So the cost of money, knowing the cost of money is critical. Critical. I
Yes.
appreciate you bringing that up.
Frank, you and I have talked about this before. You'll be in a setting where somebody says, "Yeah, I pay cash for that, vehicle X." And my first reaction is to go through the math and start thinking,
The
what's going
math.
on in the world that would make that the best decision? Not judging that person, not at all. I'm just running the math through my own personal computer to say,
Good.
I might put that money someplace else because I'm confident my investment vehicle will beat
Absolutely.
the value of that vehicle, which is already, you paid cash for it, it's already worth 20% less than you paid for it.
Right. When you drive it off the lot, it's going to
When
lose
you
value.
drive it off the lot. So
Mhm.
very important to think about that as you make your investment decisions and what you do with your money.
Mm.
So yeah, one thing we didn't talk about quite as much, you touched on it, about using other people's money, the bank's money. Sometimes you back into it, and that's how we describe it. You're making a purchase, their deal is better than you paying cash. At some point, you move to the place where you have leverage. And leverage being, and again, talking from experiences here, I had enough assets that I could say, hey, you can hold on to this, but I need X amount of dollars from you at this rate of return. In one case, it was an insurance product, which I don't want to get into a bunch of details, but they could hold access to my insurance policy. If something were to happen to me, they got paid back. But in exchange, I got money from them at a really, really low rate because they had little to no risk. And this, plus my credit was worthy, all of those things. And that allows me to say, hey, Frank, you found, 10 acres of real estate that would be a beautiful thing to own, then I'm ready to go.
That's good.
And keep in mind, I kept my asset. I just let my asset give me access to more cash. But at the end of the day, I still own what I own. And from an interest standpoint, my vehicle was growing at 6%. They loaned me money at 2.5. Like, cool, we'll do this all day long.
We'll use your money. Leverage. Leverage. That's good. That's good.
And then leverage that wasn't one we backed into, it was one we moved toward.
That's
This
right.
is how a lot of wealthy folks
That's exactly right.
get things done. Let us tell you, as a matter of fact, they don't always use their own money.
Mm-mm.
And when they you know, when they're going to buy a $80 million yacht, you think they're using their money to pay cash for that? Of course.
No way.
They're doing deals with private equity firms.
Mm-hmm.
You ever hear the term private equity firms? That's one of the things that they'll do. Is it's a transaction that you don't see when you walk in your bank.
Mm-hmm. Right.
So yeah, there's a whole other arm in the banking system that deals with things like that. Seen it firsthand.
I love it. I love what you're talking about here. It's all about building wealth, Mark. You'll get to a point once you start building your savings or building you're managing your assets better in whatever you do it, real estate, entrepreneurship, stocks, any other way that you have an appreciating asset. You start building that wealth, then you start looking for opportunities to continue to grow your wealth, right?
Mhm.
Yep. So and leverage is what's on sale. You're looking for sales. Leverage is best is when you're looking for sales. When the market is bad, when the economy is struggling, there's usually sales out there.
Mm-hmm.
And if you manage your assets, you can start taking advantage of those sales. And then and don't even use your money that's making money, 4%, 7%, 10%, whatever it's making. You use other people's money, right? Private equity, the bankers, whoever will give you that at a lower rate, right? So that's just a great way to do it. The Bible even talks about this, right? The Bible, and you reminded me of this, but it was one of our previous podcasts in season 1. We titled it, Why Does the Rich Get Richer? And the Bible talked about these 3 guys. There was basically a business owner who had 3 employees, if you allow me to say it this way. He gave one 5 pieces of, 5 stocks, let's say. He gave another one 2 stocks. He gave another one 1, right? And the guys that had 5 and 2, they doubled their money. And the business owner was very pleased with that. The guy that had the 1, he did nothing with it. So the business owner took the 1 stock from that guy who did nothing with it and gave it to the guy who had 10, because the guy who had 10 could manage money. He managed his assets well. That's how the world works. People who manage well, and they get more. And I struggle with that. My kind of my social economics and political views struggle with that scripture until I really understood the realism of it. And it's the truth, right? You have to manage. The more it snowballs, as Mark says. The better you manage your assets and you build wealth, there will be more wealth opportunities for you. And if you do not manage those wealth opportunities, in some cases, you might even lose a little bit that you have. And it's unfortunate, but it's true. So leverage is a great place for us to be. It's an opportunity we can take advantage of.
And you reminded me of something. You go back to the 2008, 2009 time frame. If you had the discipline to hang on and you bought them, I hate to use my personal examples, but that's what this is about. I made a purchase that now I had a 10 times return. So for $100 investment, I got 1,000 in return. Let's just say that worked out pretty well for me. And I still haven't sold it.
Right.
Why would I? It's working for me. Even if it has a couple of years it doesn't do as well.
You're still
Look how
up.
far ahead I am. It doesn't matter.
That's right.
I doubt it's going to drop to the point it's back to the $100 I paid for it.
That's correct.
And if it did, the assessment of the company, I still look strong, paying a good dividend, earnings per share solid. Don't get into all the technical stuff, but if it's still a good quality company, I should be looking at adding
more. Buy more.
Yeah. So, then for those of us who may be interested in the real estate game, The folks I know who've done it, they don't stop buying properties.
No,
They're always sniffing around for
absolutely.
depressed property, i.e.,
Absolutely.
on sale.
Hmm.
So that's the kind of thing that we want you to look at. Um, and Frank, I don't know if you had anything else we were going to add. Otherwise, I want
No.
to recap a few things that we
Good.
want our
Excellent.
audience to take a look at. First, first of all, set a goal on acquiring an appreciating asset, one, more, whatever works for you. Or get an education in a space like real estate or entrepreneurship,
Good.
whatever your thing is. Calculate your net worth. We calculated cash flows, etc. Debt to income we covered, net worth. Add up everything you own and be real about it, and then subtract from that everything you owe. And what number comes out that equation is your net worth.
What you're worth.
Yeah,
Financially.
Yeah. Here's a good example. I might live in a $300,000 house. Okay, I own a $300,000 house. I own a car that's I paid 60 for. It's worth 45. So I have 45, the $300,000 house, on and on and on. But then on the $300,000 house, my mortgage is 270.
Yep, that's
so
what I owe.
I really have $30,000 equity.
That's right.
I had 30,000, so my net worth would be on that transaction alone 30,000 to the good. I know we're kind of moving at a quick pace, but I'm sure anyone can follow that. I encourage you to do that. You don't only have to do it once every blue moon, because it's not like you need it very often. Now, when you go to the bank and you want something, they're going to look at that. They're going to say, "Oh, this person's worth a lot more than what they're borrowing from us for their house." We did that recently. So check your net worth, educate yourself, buy your new asset, set your window of time up, and be disciplined to buy your asset. So when you are watching our podcast 3 months from now, we may ask you if you purchased one, and you have the discipline to say you have, to yourself, of course. But if you're on your way to building wealth, you gotta start somewhere.
Excellent.
Putting it at check cashing places and under the mattress, that doesn't work.
No, that's not working. That's not working.
It's not working at all. So those are things you want to focus on. So educate yourself, calculate your own net worth, and buy your assets. Those are the key things we wanted you to take out of this podcast.
That's good.
We have more to come, probably at least two or three more in this series on finance. If you haven't seen our other podcasts, please go back and start at season 1, where you'll learn some things more about personal discipline, personal responsibility, accountability, hard work, managing your time, all of those things that also connect to your true north. Now we're putting the financial stability, at least a plan under you and a toolkit under you to allow you to move forward.
Good.
So,
Excellent.
That's what I had this time, Frank. And I think we've covered this topic the way we wanted to. Any closing remarks?
No, absolutely. Just to reiterate that finances is very important to give you the freedom to be able to exercise your true north. So we believe that God has a destiny and a plan for all of us. We believe that we need to be free to be able to do that. And in some cases, finances can either help you or hurt you to be able to free you to be able to focus on that true north area that God has for you. So we just want to give you opportunity, give you information, give you examples, right, to help you be all you can be as God has planned for you to be. So Mark, appreciate that. That's excellent. I'm excited about the upcoming podcast that we have in this season 2 of finances. So everyone, please continue to like and subscribe and keep an eye out for other future materials. Mark, appreciate all your knowledge, all your experience, right? We'll just talk to everyone real soon. Take care.